Welcome to The Explainer. Today we're digging into a $500 billion mystery right from the heart of the 2020 financial crisis. How did a simple promise from the U.S. central bank magically stop a market from crashing while they barely spent a dime?
Okay, so let's set the scene. Picture this. It's March 2020. The pandemic is sending these huge shockwaves all over the world, and financial markets are in an absolute terrifying freefall. The corporate bond market, which is, super important for funding America's biggest companies, is completely seizing up. And that's when the U.S. Federal Reserve steps up to the microphone with an announcement.
And boom, just like that, the panic just stops. The corporate bond market roars back to life, gaining over $500 billion in value almost overnight. I mean, what an incredible success for the Fed, right? But here's the puzzle, the part that has economists just scratching their heads.
So the Fed said it was ready to step in and buy up bonds, but in the end, they spent less than $15 billion. That is a tiny, tiny fraction of that $500 billion rally. So that brings us to the real question here. What were investors actually reacting to? I mean, if the Fed spending was just a drop in the bucket, what really put out the fire? To figure this out, we have to look past the headlines and dive into the kind of hidden world of what markets expect to happen. We basically need a way to read the collective mind of thousands of investors. And it turns out there's actually a place where we can do exactly that.
So, luckily for us, there's this special place that acts like a window into the future, or at least what investors think the future will be. It's called the options market, and it's where the real, high-stakes bets are made.
You can think of it like a giant global betting parlor for finance. And by looking at the prices of all these different bets, we can get a super precise minute-by-minute read on the market's collective hopes and, more importantly, its fears.
A put option is basically a bet that an asset's price is going to fall. A much simpler way to think about it is crash insurance. So the more that people are willing to pay for this insurance, well, the more terrified they are of a total collapse.
And on the flip side, you've got call options. These are bets that prices will rise. They measure how optimistic everyone's feeling. So here's the key question. What happened to the price of optimism and crash insurance in those few moments right after the Fed made its announcement? The answer tells us everything.
Well, some researchers went and did exactly that. They pulled all the data from the options market, looking at the minutes before and the minutes after the announcement, and what they found was absolutely remarkable.
So get this. After the Fed spoke, the price of that crash insurance, the cost to protect yourself from the absolute worst case, everything goes to zero scenario, it didn't just drop, it plummeted. It's like the market suddenly decided that a catastrophic collapse was basically impossible now. The fear of a complete meltdown was just taken off the table.
And that tells us that investors heard something much bigger than just the official plan. They heard an unspoken promise. They heard this implicit guarantee from the Fed, which created what analysts call an asymmetric safety net. Basically, the Fed would help out a lot if things got really bad, but they'd stand the sidelines if things got better on their own.
Okay, so here's what the market understood in that moment. If the economy got better, great, the Fed would do very little. But if things got much, much worse, if the market really started to tank, then the Fed would step in with overwhelming, massive force to stop it. This is what's known as the policy put. It's an unspoken promise to do whatever it takes, but only if it's absolutely necessary. And the effect of this promise was just stunning. When the researchers crunched the numbers, they found that over half, 53% of the entire rally, was driven by this invisible promise alone. Think about that. The belief in a future rescue was more powerful than the actual money spent. And it turns out, this isn't a new idea at all. Yeah, way back in the 2008 crisis, Treasury Secretary Henry Paulson said it perfectly. Just the belief that the government has this overwhelming firepower and is willing to use it, that alone is often enough to calm everyone down. You don't always have to actually fire the bazooka.
And what's really fascinating is when you apply this same kind of analysis to other major financial crises around the world, you see the exact same pattern pop up again and again. Just take a look at this. During the 2008 bank bailout here in the U.S., almost half, 46%, of the positive market reaction came from this belief in a future backstop. When the European Central Bank had its famous whatever-it-takes moment in 2012, 37%. The pattern is just undeniable. So what this all shows is that for a central bank, managing what people expect you to do, making a credible promise, can be a way more powerful tool than just spending money. But this all raises a really critical question. What happens when markets just get used to having this safety net all the time?
See,
These policy puts, they have these really long-lasting effects on how markets work. They're not just a one-time fix. They actually create a whole new reality for investors, and that comes with some pretty worrying long-term consequences.
After what the Fed did in 2020, something fundamental seems to have changed. The risk that investors see in corporate bonds just doesn't seem to be as connected to overall economic fear anymore. It's almost as if investors now believe that no matter how bad the rest of the economy gets, the Fed will always step in and put a floor under this one specific market. That safety net is starting to feel permanent.
And this really gets to the long-term trade-off, doesn't it? When support is always expected, asset prices can get totally disconnected from their real value. Future announcements from the Fed lose their punch because they're already priced in. And maybe most importantly, you get what's called moral hazard. If companies and investors think they'll always get bailed out, well, why not take on more and more risk? The line between a free market and a state-supported one gets really blurry.
So ultimately, this whole thing leaves us with a profound, multi-trillion-dollar question. If the market no longer fully prices in the risk of a catastrophic failure because it just assumes the government will step in, that risk doesn't just vanish into thin air. It gets transferred. So the question we're all left with is, who's really holding it now? Thanks for joining this explainer.